In the face of the looming recession and the looming threat of a significant market downturn, the importance of income investments has surged to the forefront of financial strategies. With the economic landscape becoming increasingly uncertain and traditional growth-focused investments show signs of vulnerability, investors are turning their attention to more stable and resilient options. In this crucial context, I'm going to delve into an in-depth analysis of the top 4 dividend income ETFs. These ETFs are not just any ordinary investment choices. They are meticulously structured to serve dual critical purposes. Firstly, they provide robust risk management, a necessity in these turbulent times. Secondly, they offer a reliable and steady flow of income, an attribute that becomes exceptionally valuable when market volatility is high and economic forecasts are bleak. The combination of these two features make these ETFs stand out as particularly attractive options for investors looking to navigate the choppy waters of the current economic climate. By focusing on these high dividend income ETFs, investors can potentially find a safe harbor in the storm, balancing the need for income generation with the imperative of minimizing risk. Ranking fourth on our list is DIVO, the Amplify CWP Enhanced Dividend Income ETF. This fund stands out as a balanced choice for both dividend income and capital growth, with the added perk of being tax efficient. Established in December 2016, DIVO manages nearly $3 billion in assets. It boasts an impressive dividend yield of about 5% paid monthly. While this yield isn't the highest compared to others on the list, DIVO has delivered a 100% return since its inception, matching or slightly exceeding the performance of well-known dividend ETFs like SCHD. DIVO is an actively managed ETF, focusing on income generation through a mix of stock selections from the S&P 500 and a strategic use of covered call options. It aims to generate an annual gross income of 4 to 7% from two main sources: dividends from its holdings and option premiums. This approach impacts taxation notably, as the fund combines qualified dividend income, taxed as capital gains, from its stock holdings with income from short-term covered call options, taxed as regular income. The fund's investment strategy emphasizes high-quality, large-cap companies known for constant dividend and earnings growth. This not only contributes to nearly half of the fund's dividend yield, but also offers significant downside risk protection due to the value orientation of these stocks. The portfolio shows a diversified allocation across various sectors, including financials, consumer defensive, healthcare, technology, energy, industrials, and consumer cyclicals. Interestingly, the fund allows 80% of its portfolio to appreciate in value, similar to a conventional ETF. The primary advantage of DIVO include excellent risk mitigation and capital appreciation potential. Thanks to its focus on companies with strong earnings and dividend growth history, the covered call strategy applied to a small portion of the fund's holdings further enhances this mix of income generation and risk management. Tax considerations are crucial with DIVO. Nearly half of its dividend yield comes from qualified dividends, taxed as capital gains, while the rest, generated from the option strategy, is taxed as regular income. This distinction in tax treatment is especially relevant for investors in different tax-advantaged accounts, like Roth IRAs, where dividends are tax-free, and traditional IRAs, where different tax rules apply. A notable highlight of DIVO is its 5-star Morningstar rating, unique among covered call ETFs. However, potential downsides include a relatively high expense ratio of 0.55% and a modest dividend yield of around 5%. which may not meet the needs of those primarily seeking high income. Additionally, the fund's focus on just 39 different stocks introduces a concentration risk, with its performance significantly influenced by a few key holdings. At number 3 on the list is JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This relatively new entrant, launched in May 2022, has quickly amassed over $5.9 billion in assets under management. With an expense ratio of 0.35%, it's considered quite reasonable, especially in light of its impressive dividend yield of 11.8%. This high income potential is complemented by a strong performance, with a total return of 26.5% year to date, surpassing the S&P 500's 14.5% in the same period. JEPQ is an actively managed fund that primarily invests in large-cap US companies from the Nasdaq 100 index. Its strategy involves selling covered calls against these holdings, using equity-linked notes, ELNs, to enhance returns. The fund targets call options that are 5 to 15% out of the money, with a 30-day expiration period, allowing for a balance between income generation and growth potential. A significant portion of JEPQ's assets, around 50%, is invested in technology stocks, followed by communications and consumer cyclical sectors. This high concentration in growth-oriented stocks enables a fund to not only offer a substantial dividend yield, but also to capitalize on capital appreciation. However, this focus on growth stocks also introduces more downside volatility, as was evident during the bear market of 2022. The fund's performance in this period, despite a high dividend yield, was less robust compared to the S&P 500. The primary advantage of JEPQ lies in its combination of high income and potential for capital appreciation. Yet the inherent volatility of growth stocks, especially in a downturn, means that investors could face significant price depreciation, a crucial factor to consider in a high-income portfolio. Despite these concerns, the fund's high dividend yield and growth potential make it a noteworthy option, particularly for those seeking a balance of income and growth in their investments. This blend of features is what places JEPQ at the 3rd spot on our list. In 2nd place on our list is SVOL, known as the Simplify Volatility Premium ETF. This ETF, which I hold in high regard, distinguishes itself with a unique strategy, unlike any other on this list. Since its inception in May 2021, SVOL has demonstrated impressive performance, returning nearly 25%, which is a substantial outperformance compared to the S&P 500's 9.1%. Despite being a recent entrant into the market, it has accumulated almost $400 million in assets under management. The fund does have a higher expense ratio at 0.66%, but this is offset by its extraordinary dividend yield of 17.7%. What sets SVOL apart is its approach to generating income. It doesn't invest in stocks or use a covered call strategy. Instead, the fund strategically shorts volatility futures and hedges against significant market shifts by buying UVXY calls. This strategy is based on betting against future market volatility and profiting when volatility decreases, while simultaneously protecting these bets by purchasing call options on the VIX to hedge against sudden spikes in volatility. SVOL utilizes only 20 to 25% of its assets to short volatility, providing considerable protection against abrupt increases in market volatility. Its low correlation with the broader market, indicated by a beta of 0.58, makes it an intriguing option for diversifying investment portfolios. One of the most compelling aspects of SVOL is its dividend yield. At 17.7%, it far surpasses the yields of most covered call ETFs, offering an attractive source of income, particularly in a bear market. However, there are reasons why it's not the top ETF on our list. Its relatively high expense ratio and issues with liquidity, given its smaller size, are considerations for potential investors. Additionally, while the fund employs strategies to mitigate risks associated with market volatility, it remains more vulnerable to downside risks compared to ETFs investing in value stocks. In the 2022 bear market, for example, SVOL's total return only dipped by around 5%, a performance buoyed by its high dividend yield, but still showing notable price depreciation. Overall, SVOL's unique approach and high dividend yield make it a standout ETF, particularly for those looking to balance income generation with a different take on market volatility. Topping our list is JEPI, the JP Morgan Equity Premium Income ETF, which has been my go-to high dividend income ETF for some time. JEPI excels in blending high income generation with effective risk mitigation, making it an ideal choice for both income-focused and defensive investors, particularly in bear markets. Launched on May 20th, 2020, JEPI manages nearly $30 billion in assets, a testament to its popularity and effectiveness. The fund maintains a reasonable expense ratio of 0.35%, identical to that of JEPQ. JEPI's investment approach mirrors JEPQ's, focusing on S&P 500 stocks and employing a covered call strategy using equity-linked securities, ELS, to create income. However, JEPI sets itself apart with its selection of low volatility, value-oriented stocks within the S&P 500, similar to DVO. The fund's holdings are well diversified across sectors such as technology, healthcare, industrials, financials, and consumer defensives. This strategy effectively combines dividends from its holdings and income from its option strategy, while around 2% coming from qualified dividends and around 8% from options. JEPI's focus on high income and defensive investments is underscored by its resilience to market downturns. For instance, during the 2022 bear market, JEPI's value only dropped by 3%, significantly outperforming the S&P 500, which fell by nearly 20%. This performance highlights JEPI's strength in risk mitigation, underscored by its low beta of 0.62. JEPI's value-oriented approach provides the upside potential of high dividend yields without the capital appreciation seen in more growth-oriented ETFs like JEPQ. Comparatively, JEPI has outperformed DIVO and other popular value-oriented dividend ETFs due to its robust dividend yield. However, potential investors should note that JEPI's dividend yield can fluctuate due to the variable nature of premium income influenced by the market volatility. This means the dividend income might vary month to month, unlike more stable, regular dividend ETFs. In conclusion, JEPI, along with SVOL and JEPQ, form a powerful trio for those seeking a high dividend income portfolio that balances substantial yields with risk mitigation and capital appreciation. These three ETFs represent a well-rounded approach to income investing. Stay tuned for more detailed insights into high-income investing strategies in my upcoming content. Remember to subscribe to my channel for more updates and hit that like button to support the channel. Thanks for watching, and I look forward to sharing more insights in the next video.